Thank you, Matt. Yes, so market maker move is the topic of the day. We've got earnings tonight on Meta. You've got earnings tomorrow night on Apple. And this is a story we've told before. This is a segment I think I do probably every earnings season. We do something around trading the earnings gap. So let me tee this up. So first of all, this idea of like the wisdom of the market, the wisdom of the crowd. There is a way for the marketplace to essentially, oh, what's the word I'm looking for? Compile all of the bets, all of the opinions, and just kind of see for the people that bet, for the people that put their money where their mouth is, what are the odds, right? Like what's the baseline odds going into an earnings announcement? And when we talk about what are the baseline odds, I'm not talking up or down. Okay. Those odds are always 50-50. You can look back historically and you can look at the last 50 earnings announcements for Meta, and you could try to figure out how many times do we gap up, how many times do we gap down. It doesn't really matter. I'm telling you that it's pretty much a coin flip every time. So you can't really be like, oh, 70% chance of going up into this earnings announcement. No, that's 50-50. When we talk about what's baked in, we're talking more the magnitude of the move, not which direction, but how much is it going to move. And so the market maker move looks at option prices, which are set by supply and demand, the collective buying and selling of everybody who's jockeying for a position ahead of earnings. How much are they willing to pay? And you can infer from option prices how much Meta would have to move to justify what people are paying for the options. Okay, that's what implied volatility is. How much would the stock have to move to make current option premiums fair? Okay, so when you go to the trade tab in Thinkorswim, up at the top, if there's an upcoming earnings announcement, this MMM will become available. It's not always up there. Usually it's only when there's an earnings announcement or some event coming up where short-term options are trading a lot more expensive than long-term options. So market maker move, plus minus. Again, maybe it'll go up, maybe it'll go down. It's not a matter of up or down. It's just the size of the move. Right now it's $14.70. Okay, $14.70. Now you'll notice this expected move is already priced into each option's expiration over here on the right. It's already telling you what the expected move is over these various timeframes. Okay, how much is Meta expected to move between now and January 20th of next year? Well, it's expected to move $31.87 up or down. Well, that's 86 days away. Okay, what we're trying to isolate with earnings is like tonight. I don't have 86 days. I just want to know what they're going to do over the next like 24 hours. So use your head here. If it's expected to move $31 over the next 86 days, I promise you it's not expected to move more than that in the next one day. It's going to be quite a bit less. And so what you'll see is the expected move is linked to time. There's a distinct relationship there. The more time, the bigger the move. This is intuitive. If it's got 25 days to move, it's got more time to go up and down than if it has 25 minutes, right? So the way the market maker works is it tries to isolate essentially just the next day. And another way I could back that up, like I'm just not spouting off the mouth here. Go look at the 2-day options. What are the 2-day options pricing in? $15.50 move. Well, why is earnings less than that? Because it's not 2 days, it's only 1 day. So naturally, the 1-day move expectation is less than the 2-day move, right? So $14.70. That's the expectation. That's the baseline. What is that as a percentage? Divided by the current stock price, $130.37. It's about 11%, 11.3%. That's what's baked in right now. Okay. Does that mean there's a 100% chance Meta's going to move 11.3%? No. See, what they do is they put some confidence intervals around that. Okay. What they say is that the market maker move is a 1 standard deviation move, which in statistics, that represents about a 68.2% chance. Or in other words, if you did this 1,000,000 times, 68.2% of the occurrences would be within that $14.70 move. So it's about 2/3 of the time. Okay, so 2/3 of the time, if the market's pricing things right, you will see us stay in that expected range. Okay, 2/3 of the time, it's going to move $11 and or $14.70, 11%, and then a third of the time, it could move more than that. Okay, so even if Meta goes up tomorrow by $17, $18, $19, it actually doesn't mean that the market maker move was wrong. For you to know if it was wrong, you would actually have to have a lot of occurrences to see if more than a third of the time you move more than that, right? So that doesn't really influence your decision, I guess, in any one instance. It's just more to understand the way the math works. So why do I care? Well, I care because if you're going to do a trade into earnings tonight on Meta, you have to have an opinion on this. You have to either be of the opinion that the market's right and it's going to move $14 or less, or the market's wrong and it's going to move a lot more than that, right? And that's going to influence your strategy selection, because fundamentally you have two choices. One is to bet that options are too cheap and that Meta is going to bust a move and move more than 11%. And maybe it will, right? I mean, if you think that Google and Microsoft not doing well today is an omen, right? A harbinger of things to come. The ad revenue wasn't good with Google. I'm assuming it's not going to be great with Meta either, right? So Meta's falling today in sympathy, but maybe it's not falling enough. I mean, if you think they're just going to screw the pooch here and really get hosed, then you might be of the opinion that we're going to move more than $14.50, right? So you'd want to be a buyer of volatility. You want to buy options, betting we're going to move more than that. And you do that by buying straddles or strangles or inverted butterflies or debit condors, the bi-directional trades, right? Or you say, nah, I mean, listen, I think it's going to be a snoozer and I think the market's got it right. I don't think it's going to move more than 11%. So let's sell options. Let's sell a condor. Let's sell a strangle, betting that we're going to stay within the expected range. Conceptually, tomorrow morning, if Meta moves more than $14.70, you can probably take it to the bank that anybody who bought a straddle, who bought a strangle, who did an inverted condor, an inverted butterfly, probably made money. Probably made money tomorrow morning. They'll be making money. If we move less than $14.70, if we open tomorrow up $10, down $10, within that $14.50, probably means that if somebody sold an iron condor, sold a strangle, did some kind of short volatility trade, probably waking up to a winner tomorrow. And so those that are trading vol into this announcement, they care about the triple M, the market maker move. They use that to make an informed decision. And the final point is, if you don't have an opinion, you're probably not playing. It's just like any other chart that we come up. We're like, I don't have a strong opinion. But you're not going to play. But you can at least know, like, what's the status quo, what's the baseline odds, to then decide if you have an opinion or not.